September's real estate market report is out, and I have two areas of concern. Hi there, I'm Nawar Naji, a real estate broker in the city of Toronto. Now, we are 7 months approximately into this COVID-19 pandemic, and if you recall, the first 2 months out of the year, January and February, were extremely busy in the real estate market. Things were very active, and even the month of March, up to March 15th, 16th, and then all of a sudden, everything came to a complete halt. Over the summer months, I saw social media and online posts of other agents saying, the market is up 20, 30, 40%, and like, my reaction was, yeah, okay, that was anticipated. And for the simple reason is the busy spring market got pushed back by 2 months. Because if you recall, for about 2.5 months till end of May, after they made Q4, pretty much around there, that's when the market came back to the normal level. So that spring busy market got pushed back by 2 months. So historically speaking, July, August of 2020 looked extremely busy compared to July, August 2019, 2018 and the previous years, because those are the typical months where people go on holidays, vacations, cottages, which was not the case this year. Now, I was waiting for September's report to get a good feel for where things are headed, and so far things do look good, with two red flags that I'm concerned about, which I will discuss in this video. Let me tell you about September first before we get into the red flags. For September, a little bit of numbers for you. The sales were up 42%, so 42% higher than September 2019, which is a good solid sign. The new listings were up by 30% compared to 2019. So this is a number to keep in mind, because if the sales are growing faster than the supply, means the absorption rate is strong or faster, which means there isn't enough supply in the market, which will continue to push prices up. And this is why you see the average price is up by 14% in 2020, September, compared to 2019, because there are more sales than supply coming onto the market. So that's a figure to keep in mind. Now, if you break it down into the 416, 905, 905 was just on fire. It was just madness. And, people were leaving the city, work from home, which is something I'm going to discuss, and, getting out of the condo market, trying to buy a detached house, semi-detached house with a fence and a backyard, out of the city. Generally speaking, the 416, and I'll just run this very quickly, detached were up price-wise by 9.4%, semis were up by 7.2%, and condos were up 7.7%, which is surprisingly very resilient and positive. But we'll discuss the condo market in a minute. In the 905, it was just crazy. Detached were up 16.9%. Semis were 14.7%. Condos were 8%. It was just very strong activity in the 905 and demand for that outskirts outside of the city of Toronto. Now, looking at the big picture, I wanted to see where we are year to date. So the first 9 months of sales activities in 2020 compared to the 9 months of 2019. And the reason this number was important for me is because January, February, mid-March were very active, things went complete halt and things picked up. You really couldn't compare month to month. Again, because of the shutdown and the lockdown, things got offset, and doing that apples to apples comparison was not really possible. So I looked at the first 9 months compared to the first 9 months of last year, and believe it or not, we are ahead in sales. So in 2020, up till end of September, we have had 68,793 sales, compared to the end of September 2019, we had 67,890. So about 1,000 more sales in the same period, 2020 to 2019. So that's positive. That is a good sign for the market moving ahead. And it looks like we might end up around the same number by end of Christmas, around that 87, 88, might be very close to the 90,000. We'll have to wait and see how things are going to play out for October, November, and December. So here are the two red flags that I see: the condo market and the 905. Now, with respect to the condo market, let's step back for a second. There were a lot of new projects completed. Airbnb got, well, I shouldn't say Airbnb, short-term rentals got decimated. And then the job demand for the city, for the core, is much, much less because now people are working from home and there's no demand for people to move to the core to be close to work and live, work, play. So all those three factors have put downward pressure on rental prices with respect to the condo market, but also that is slowly filtering down to the demand of buying those condos. Because eventually, as investors realize that, instead of renting for X, they have to rent by 80% of X, so 20% reduction in rental rates. So for some of them, it might not make sense, and they've decided, or they will decide in the near future, to cash out. So that will increase, and actually we already saw that in September, the increase of supply of condo listings for sale in the market. So I'll give you some numbers here. So C1 and C8, so this is Dufferin, DVP, Bloor to the Lake. The sales, there were 530 sales, condos, and new listings were 2,219. So if you look at that ratio, and that is a good indicator of the strength of the market, 23.9%. So sales divided by new listings is 23.9%. 40 to 60% is balanced. Below that is a buyer's market. Above 60 is a seller's market. So clearly you can see that the condo market is in buyer's territory and probably, most likely, will continue in that trend until the jobs come back to the core. So how do you position yourself as a real estate investor? Number one is you got to be patient and you have to anticipate lower rent for the future. As a homeowner, there will be buying opportunities in the condo space. Now, this applies to the real estate investors if you're looking to invest in condos. And what I mean by opportunities, it's not necessarily buying a condo for 20% less than listed. What it means is you will get it around, I should say, less than the listing price with minimal competition or no competition. You can put condition on financing, you can put condition on obviously status certificate review, but it's just less competition just because there's a lot of supply versus the demand. So keep that in mind. The second red flag that I see is the 905. This might not be very popular, but I'm seeing people go crazy buying and overbidding for houses and homes in the 905. Now, we got to think long term. Let's back up here. Long term, jobs have to come back. I do believe, strongly believe, jobs will come back to the city. I just cannot see employers saying, forget it, you can work from home forever and forget about it. You don't need to rent an office, you don't need to come to the office downtown. For a couple of reasons. One is, I call it the Google effect. It's that corporate culture. Corporate culture and identity is not built via Zoom, via FaceTime, via WebEx, via online meetings. It's built with human to human interaction and building team chemistry. And that cannot be built online. It doesn't really, I don't know how we can argue this till the cows come home, but we are human beings and we develop relationships in person. Yes, it could start online, but eventually it turns into a face-to-face meeting. It turns into, employees working together, having water cooler chats. They do lunches together. They do activities after work together. They go for dinner, drinks after work. They do things on the weekend. They hang out together. Some companies have built, open collaborative spaces to share ideas and cross-pollinate thoughts and different projects to create that identity and culture. You can't replicate that online. I don't know what technology will be available, in 5, 10, 15 years from now. I just can't see that happen. And this is why we got to think long-term, because eventually this pandemic will be addressed, whether it's a vaccine or some type of medication or, whatever the medical and science community will come up with down the line. These jobs will come back. The engine of the economy is in this city. It's in Toronto. There is no way, and I could be wrong, but there is just no way the politicians will let the core hollow out. They will not let, the bank towers and the office towers and all the service providers. So you have restaurants, retailers, shops, entertainment, all that stuff will completely collapse and become like a US city where people come to work and then leave. I just don't see that happening from a long-term perspective. Now, will some companies allow their employees to work from home once a week, twice a week? Sure. Will there be some positions they can work remotely? Sure. But for the majority, I just don't see that happen. It's, at the end of the day, we are human beings. We share ideas in person, we connect in person, and you can't replicate that on a computer, on a tablet, on a camera. It's just not the same. So my word of caution is for the people going out to the 905 and bidding against 5, 7. There was one house I saw with clients, 21 offers in Whitby. Take it down a notch. Just think long term. What guarantees are there that your employer will say, you can work from home for the next 5 to 10 years? If you're planning to find a job out in the 905, fine. It is what it is. You're gonna find a job close to work and you should be good to go. But for I guess next year, maybe 2022, by then hopefully we'll have this thing addressed and managed properly. Companies are gonna pull their employees down back to the office space. And people commuting for 2 to 3 hours a day, again, look out for 2017. There was a huge uptick in the 905 sales, and then things really went down. So just keep that in mind. Don't think about the next year or two. Think 3, 4, 5 years if you can, if you're able to. And it is difficult to predict what's going to happen with the economy, job security, and all that type of stuff. But just think, if your employer says you got to come back to work, how's that going to work out? Do you want to spend 3 hours sitting on a GO train and a subway in a car and all this kind of stuff? Most of us don't want to do that. So just keep that in mind when deciding, where to make your next move. I'll give you an example. This is Clarington. So this is Bowmanville, Newcastle, east of Oshawa. This is, talk about a strong market. There were in September 2020, there were 201 sales, and there were 243 new listings. So 201 sales and 243. So pretty much everything that comes on is getting absorbed. And the average price was $764 with a median of $725. I like to look at medians because that strips out any high or low sales. So a good example is in the city of Toronto, because some pockets you might have, very expensive homes, and then you have average homes. If you have a couple of sales in the high end, that will just skew the average. I like to look at the median as well as a good indicator. So I want to leave you with a couple of thoughts here. One is, if you are a homeowner looking to buy into this market, in the condo space, there will be opportunities for negotiation and getting things below ask. If you're an investor, there will be opportunities to buy, but you have to be patient and expect lower rent than what you were getting or you were able to get or can get 8 months ago. If you're a homeowner looking to buy a family home, again, consider 905. How's that going to look like? What are the long-term implications, employment, and just give that a thought before you decide to jump into the 905 and compete against 7, 8, or that one house was 21 offers, which is absolutely crazy. If you're looking to buy, sell, or invest, please feel free to reach out. I'd be more than happy to share my thoughts, analysis, and data with you to help you make the right decision for you and your family. And until next time, happy investing.